Let's talk a little about our transaction cycles. The first thing I want to talk about is where they come from before I get into the details. When we talk about the financial statements made up of financial information, and that financial information relates to everything that the business does, right? So when we talk about what the business does, all its financial information, where does it come from? It comes from all their transactions, right? So what we're trying to figure out and what we're looking at is a way to identify how transactions should take place. They're recording the documents that should be used, the controls, etc., etc. And instead of going through each and every single type of transaction we could possibly have, we break down the transactions into certain cycles, and we say, if we can identify specific documents, purposes, controls for each of our cycles, it will cover most to all of the transactions that a company can enter into. What's really important for me is that you understand the purpose rather than the specific documents and controls, because every company has different controls, right? Every company has different documents. So one client is not necessarily going to use the same process as another one. That doesn't mean that they're wrong. We need to identify whether they're fulfilling the purpose and the objective that they're there for. If we take a look at a business, and I'm going to start by talking about sort of a basic retail business or manufacturing or whatever you want to call it, but let's take a look at a basic retail to begin with. When we're talking about our retail, we're going to have inventory that we sell, right? So we sell inventory, and obviously once we've sold the inventory, we need to purchase more inventory so that we have inventory so that we can sell it, so we can buy more, and okay. So this, as sort of in a very basic sense, is what we talk about as our operating cycle, right? So this is our operating activities. And this is basically the core of the company, right? This is the core of their business, the inventory that they sell, the inventory that, that they make, whatever the case is. That's the operating activities. And the idea is to make enough from the sale that instead of investing all of it back into purchases, that you can make investments as well. You can buy additional assets, you can have financial investments, invest in other companies, etc., that type of thing. So we have investments. There's also the possibility that in order to get your operating activities running, and in order to get your company running, to expand operations, etc., you may need additional finance, right? So in terms of where our money comes from, our money could come from equity, from the shareholders themselves, or it could come from finance, and finance could put the money in to buy your inventory, to to pay for purchases, to expand the business, etc. So we could get loans from the bank in order to fund the investments so that we have assets to make the inventory, etc., right? And this would be our finance cycle, or our financing activities, right? So finance and investment activities, if you will. All I'm trying to indicate here is that these are two fairly separate cycles, if you will. They're fairly separate activities, and although they are separate, and we're going to look at them separately, they are interrelated, right? And especially here at the bottom, where we deal with sales, purchases, and inventory, we're going to go through revenue as a cycle. We're going to go through purchases as a cycle, inventory as a cycle. But we can't forget about the fact that they are interrelated. So some of the stuff when we're dealing with inventory is going to impact our sales, right? Because when inventory leaves inventory, it should leave inventory because it becomes a sale. And when we make purchases, in a lot of cases, what we're purchasing is inventory. Obviously, there are other costs as well, which we kind of add into our purchases and most of our purchase controls will cover that. The only cost that we deal with separately is our payroll cost, right? Because the controls around that and the documents are quite different, but it still is the same idea in terms of the funding necessary to operate the business, the costs, etc., etc. Again, depending on the type of business that we're dealing with. So all I really want to indicate is that although we're going to be dealing with cycles, investment and finance cycle, revenue, purchases, inventory, etc., and all their related accounts, I want you to keep seeing the business as a whole. And what we're trying to do is identify everything that goes on in the business and say, well, can we categorize it into a cycle? And then by studying cycle controls, we don't have to study how every single transaction should work. Whether we're dealing with bank charges or sales or commission or insurance or whatever, we can relate back to the cycle that it falls into and have some understanding about how that works.